two companies, almost the exact same pitch. Build software that helps governments and giant corporations turn messy data into artificial intelligence they can actually use. One of them is now worth over $300 billion and just posted 85% revenue growth. The other one just watched its revenue shrink by more than a third, lost its CEO, then brought that same CEO back to fix the mess he left. Same industry, same customers, completely different outcome. Today, we're breaking down Palantir versus C3.ai, and by the end of this video, you'll understand exactly why hype and reality can tell two very different stories about the same corner of the stock market. Let's find out. If you found our last video on Palantir helpful, this one builds directly on it. So go ahead and subscribe so you don't miss the rest of this series. Like the video if head-to-head stock comparisons like this help you invest smarter. And comment below which two stocks you want us to compare next. Let's set the stage properly, because on paper, these two companies sound almost identical. Palantir Technologies builds software platforms called Gotham and Foundry that help governments, militaries, and massive corporations organize huge amounts of scattered data and use artificial intelligence to make faster decisions. C3.ai, trading under the ticker AI on the New York Stock Exchange, builds what it calls enterprise AI applications, software that helps large organizations, including energy companies, manufacturers, and government agencies, deploy machine learning and generative AI across their operations. If you just read the mission statements of both companies side by side, you'd struggle to tell them apart. But here's what most investors completely miss. The mission statement was never the thing that mattered. Execution was. Let's go back and tell the story of how these two companies actually got here, because the history explains almost everything about where they stand today. Palantir was founded in 2003, born out of the post-September 11th push to give U.S. intelligence agencies better tools for connecting scattered information. It spent over a decade quietly building trust with defense and intelligence agencies before expanding into commercial industries and eventually going public through a direct listing in 2020. Its founders, including Peter Thiel and longtime CEO Alex Karp, built a company culture that leaned into controversy rather than avoiding it, and used deep, multi-year government relationships as the foundation for expanding into the private sector later. C3.ai has a very different origin story. It was founded by Thomas Siebel, the same entrepreneur who built and sold Siebel Systems, once one of the biggest customer relationship management software companies in the world, to Oracle back in 2006. Siebel launched C3.ai to apply artificial intelligence to industries like energy, utilities, manufacturing, and defense. The company went public in 2020 as well, riding an early wave of enthusiasm for pure-play artificial intelligence stocks. For a while, C3.ai was actually one of the hottest tickers in the market, briefly trading at a valuation that implied massive future growth. But this is where things become interesting, because the following few years tell two completely opposite stories. Let's get into the financial comparison, because the numbers here are honestly staggering once you put them side by side. In its most recent reported quarter, Palantir posted revenue of roughly $1.6 billion, up around 85% year over year, with US revenue growing even faster than that. Net income came in around $870 million, more than quadrupling from the prior year, with adjusted operating margins near 60%. On a trailing 12-month basis, Palantir now generates over $5 billion in annual revenue, with a profit margin above 40% and return on equity above 30%. This is the company that is growing fast and making real money while doing it. Now here's the number that changes everything when you flip over to C3.ai. For its full fiscal year, C3.ai reported revenue of roughly $250 million, which was actually down 36% from the year before. Not down in growth rate, down in total dollars. Its net loss for the year widened to roughly $470 million, meaning the company lost almost twice as much money as it even brought in through revenue. Subscription revenue, the core recurring piece of its business model, fell even harder than total revenue. And in a moment that tells you everything about how rough this stretch has been, Founder Thomas Siebel stepped back into the CEO role in the middle of this year, after describing the company's recent sales performance as, in his own words, entirely unacceptable, to the point of surreal. This is what Wall Street isn't talking about enough when people lump every AI software company into the same basket. Palantir's operating margin is positive and expanding. C3.ai quotes gross margin sits in the 30 to 40% range, but massive operating expenses relative to its shrinking revenue base have kept it deeply unprofitable, with no clear timeline to break even. Palantir is sitting on billions in cash, with almost no debt. C3.ai still has a meaningful cash cushion of a few $100 million, partly boosted by Siebel personally buying shares to shore up confidence. But it's burning through that cash, while revenue moves in the wrong direction. So why did these two companies, built around such a similar mission, end up in such different places? This is exactly where the real lesson of this video lives. The first reason comes down to business model discipline. Palantir focuses on building extremely deep, sticky relationships with a relatively small number of massive customers, often locking in multi-year contracts across government and large enterprise clients. Once an organization builds its operations around Palantir's platform, ripping it out becomes incredibly disruptive, which gives Palantir enormous pricing power and predictable, recurring revenue. C3.ai, by contrast, has struggled with sales execution and deal consistency, with management itself acknowledging the go-to-market strategy needed a complete overhaul. A great product idea without a repeatable, disciplined sales engine behind it can only carry a company so far. The second reason is timing and momentum in the AI adoption curve. Palantir's AIP platform arrived at exactly the moment large enterprises were desperate for a safe way to deploy generative AI on their own sensitive data. And the company aggressively ran hands-on adoption programs called AIP bootcamps to get customers up and running fast. That timing turned into real, measurable revenue faster than almost anyone expected. C3.ai has pursued a similar vision, but has repeatedly restructured its sales approach, shifted its pricing model from subscription-based to consumption-based and back again over the years, and struggled to convert enterprise interest into large, stable, recurring contracts at the same pace. The third reason is under the surface, but it matters enormously, and it's leadership consistency. Palantir has had the same CEO, Alex Karp, since the company was founded over 2 decades ago, providing a level of strategic consistency that's rare in the technology industry. C3.ai has seen far more turbulence at the top, and the recent return of its founder to the CEO seat, while it could genuinely be a turnaround catalyst, is also a signal that previous leadership transitions didn't deliver the results the company needed. Now let's be fair to both sides here, because neither story is entirely one-dimensional. C3.ai does have some things going for it that are worth mentioning. Federal, defense, and aerospace bookings actually grew significantly in recent quarters, up over 100% year over year in one recent quarter, suggesting the government side of its business still has real traction, even while the broader commercial business struggles. The company also has meaningful partnerships with major cloud providers. And if Siebel's turnaround plan succeeds in fixing sales execution, there's a real possibility C3.ai stabilizes and grows back into a smaller but more disciplined business over the next few years. The stock trading around $10 to $11 a share, down dramatically from its highs, does reflect a business that the market has already priced for serious ongoing struggle, which means expectations are now quite low. On the Palantir side, the risks we covered in our last video still apply just as much here. The stock trades at a price-to-earnings ratio north of 130, a price-to-sales ratio near 67 times, and by some discounted cash flow estimates, is priced well above what a conservative model would consider fair value. Palantir has also pulled back significantly from its all-time highs earlier this year, at one point trading above $200 a share before falling into the $100 to $130 range. A reminder that even the stronger of these two companies is not immune to serious volatility when growth expectations shift even slightly. So what does this comparison actually teach us as investors? This is the real takeaway, and it's more valuable than either individual stock pick. Being in a hot industry is not the same thing as being a good investment. two companies can use nearly identical language in their investor presentations: artificial intelligence, enterprise data, government partnerships, digital transformation, and still deliver completely opposite financial results. Because execution, sales discipline, customer retention, and leadership consistency are what actually separate winners from laggards over time. The label on the box matters far less than what's actually happening inside the business. Let's talk valuation and verdict for both names, because they land in very different places. For Palantir, the fundamentals remain genuinely excellent: strong growth, real profitability, expanding margins, and a business model with serious pricing power. But the valuation remains one of the most demanding in the entire stock market, and that combination puts Palantir closest to a hold for valuation-focused investors, and a speculative buy only for growth investors with a high tolerance for volatility, who believe the AI infrastructure story still has years of room to run. For C3.ai, the turnaround story is real, but unproven. Declining revenue, a widening net loss, and a sales organization still being rebuilt from the ground up make this a genuinely high-risk situation. Until there's clear evidence that Siebel's restructuring is translating into stabilized or growing revenue over multiple consecutive quarters, C3.ai sits closest to an avoid for conservative investors, and only a highly speculative watch list name for investors specifically interested in turnaround stories who understand they could lose a significant portion of their investment if the recovery doesn't materialize. Looking 3 to 5 years ahead, the enterprise AI software space is almost certainly going to keep growing as a whole. But this comparison is a perfect example of why picking the right company within a hot sector matters so much more than simply picking the sector itself. Palantir's challenge going forward is proving it can keep growing fast enough to eventually justify today's rich valuation through actual earnings growth. C3.ai quote's challenge is far more basic. It needs to prove it can simply stop shrinking and rebuild a functioning, repeatable sales motion before investors even start asking questions about long-term growth potential. So let's bring this all together. Palantir and C3.ai started from remarkably similar places, chasing the same enormous opportunity in enterprise artificial intelligence. One executed with discipline, consistency, and precise timing, and became one of the most valuable software companies in the world. The other struggled with sales execution and leadership turnover, and is now fighting to stabilize before it can even think about growth again. If this comparison helped you think differently about AI stocks, hit subscribe so you don't miss the next one in this series. Like this video if honest side-by-side stock breakdowns are useful to you, and comment below which two stocks you want us to compare next. Don't forget to turn on notifications so you never miss an upload. Thanks for watching, and we'll see you in the next one.